Welcome back, everyone. I am absolutely thrilled you're here for another deep dive on our explainer. Today, we're unpacking a really wild financial mystery, and honestly, it perfectly captures that constant tension between Wall Street hype and fundamental real-world math. We're looking at Protagonist Therapeutics, ticker symbol PTGX. If you're a fan of corporate paradoxes, you're going to love this one. We're going to break down exactly how the market evaluates a company that's simultaneously skyrocketing in price while burning through cash at an absolutely astonishing rate. So let's jump right in. All right, check out this number, $6.258 billion. That is the current market capitalization for Protagonist. We're not talking about some tiny, under-the-radar microcap stock here. This is a massive, multi-billion-dollar entity. Hitting a valuation north of $6 billion establishes them as a genuine Wall Street heavyweight, meaning they command serious attention from big institutional investors. And when you hit that size, expectations aren't just high, they're sky high. And, well, the hype is definitely paying off for them right now. Over the trailing 12 months, they've posted a total return of over 118%. Think about that. They have more than doubled their investors' money over the last year, with the stock trading right around that $100 mark. In any kind of market environment, practically 120% return in just a year is explosive. It paints a picture of a massive market winner, the kind of stock everyone is scrambling to get a piece of. Okay, let's dive into this, because this is where our financial detective story gets really interesting. The stock is soaring, the market cap is in the billions, but we have to ask the absolute most basic, fundamental question in business. Is Protagonist Therapeutics actually making any money? Wall Street loves a good growth story, sure, but eventually the math has to add up. Well, looking at their trailing 12-month numbers, the reality is pretty stark. On the top line, they brought in about $46 million in revenue. But then look at the bottom line. Their net income is negative $130 million. So they aren't just failing to turn a profit. They're basically running a financial bonfire right now. For every single dollar coming in the door, almost $3 are going right back out in losses. That is a colossal cash burn. So how in the world is the market justifying a $6 billion valuation for a company burning cash like that? We have to look at the valuation metrics, starting with the price-to-sales or PS ratio. Just as a quick refresher, this compares the company's total market value to its current actual revenues. Basically, it tells us exactly how much investors are willing to pay today for just $1 of the company's sales. It's the go-to way to see if a growth stock is priced fairly relative to the cash it actually brings in. Get this. PTGX's PS ratio is 136. Honestly, let that sink in for a second. Investors right now are paying $136 for every single dollar of sales this company makes. It's like going to a local lemonade stand and handing them $136 for a $1 cup of lemonade. In the broader stock market, a normal PS ratio is maybe 2 or 3. Even high-flying tech companies might just push into the 10s or 20s. 136 is just astronomically high. It tells us the stock price has essentially zero connection to current sales. Okay, so if the price is totally disconnected from sales, what about earnings? Let's check our next core metric, the price to earnings, or PE ratio. This is probably the most famous metric out there. It measures the share price against actual profit. Normally, it's a handy way to see how many years it would take for the business to earn back its stock price. Well, here's the massive red flag. Their PE ratio is negative 47.99. You know the drill. You literally cannot calculate a normal PE ratio if a company has zero earnings. Seeing a negative 47 means the market is valuing this company in the billions entirely on the hope and a prayer of future profit, not present reality. There is absolute zero profit here today. And we see this exact same wild premium with the enterprise value to sales ratio, which is sitting at an incredible 123.67. Enterprise value is essentially the price tag to buy the whole company outright. When this ratio is that high, it translates to something very specific about investor psychology. It means people are making a massive, highly speculative bet on future breakthroughs. They're already pricing in blockbuster drugs and huge future cash flows that, right now, just do not exist. Which obviously brings us to the elephant in the room. If they are losing $130 million a year and their revenues are tiny by comparison, how do they survive? Seriously. How does Protagonist keep the lights on, pay their top-tier scientists, and fund these expensive trials without just collapsing? Well, if we pop the hood and look at their balance sheet, it's actually incredibly strong. First off, zero debt to equity. They are entirely debt-free. Next, look at the current and quick ratios, both up at 12.71. That means they have nearly 13 times the liquid cash needed to cover their short-term bills. And sure, net income is deeply negative, but their gross profit margin on the revenue they do generate, it's a flawless 100%. So what this tells us is that they have completely secured their survival runway. This is a huge concept in biotech investing. Despite burning over $100 million a year, that pristine balance sheet, zero debt, and massive cash reserves mean bankruptcy is nowhere in sight. They have essentially bought themselves the runway they need to try and turn their research into a profitable reality. Let's move into Section 1, the true valuation check, confronting the fair value.
So we've seen the unbelievable market hype pushing the stock toward $100, and we know they have the cash to survive. But what is the actual mathematical worth of this company? To find out, we use a discounted cash flow, or DCF model, to find the fair value price. This strips away all the emotion, all the momentum, and just looks strictly at the math. Based purely on the cash this business is projected to produce, what should one share cost today?
All right, brace yourselves for a serious reality check. The market right now is happily paying about $98.37 for a share, but the calculated DCF fair value price, it's just $20.79. That gap is just a total chasm. The market is paying roughly 5 times what the fundamental cash flow math suggests this company is actually worth. Because of that massive gap, we're looking at a staggering margin of safety of negative 373.2%. In investing, a negative margin like that means there is absolutely zero buffer. You are paying an incredible premium. It highlights just how overpriced the stock is compared to its fundamentals. Honestly, if their future execution is anything less than absolutely perfect, this stock has a very, very long way to fall to meet its intrinsic value. So what's the big takeaway from all this? We've got this fascinating paradox. On one hand, Protagonist has a pristine, debt-free balance sheet with tons of liquidity. But on the other, it's treating its sky-high valuations like that 136 PS ratio that demand flawless future execution to even justify. So I'll leave you with this to ponder. Is PTGX a brilliant bet on a company that's going to revolutionize its sector, or is it just a massive market bubble waiting to meet gravity? Thank you so much for hanging out with me for this explainer. Keep learning, keep questioning the numbers, and I'll catch you on the next deep dive.